That's super bright. I agree. After the last panel, this is going to seem, easy peasy. Selling your company's a piece of cake. So we'll start with brief introductions. My name is Allie Love. I'm the co-chair of Tech and Life Sciences M&A at Freshfields, which is a large multinational law firm. I do M&A every day, all day. That's pretty much the only thing I've ever done in the course of my career. I do both buy and sell side. But a lot of people, as is the case with, I think, founders, people say, well, why do you love what you do? So let me answer that question. Why do I love what I do, and what gets me up in the morning? As much as I love my buy-side clients, they're not the ones that get me up in the morning. What gets me up in the morning is all of you. I learned maybe about halfway through my career, I'm a lot older, I've been told, than I look, that representing individuals, and I represent companies, but at the end of the day, companies are made up of individuals. Representing individuals who have done this thing, this halfway between genius and insanity for most of their life. Most of you have underpaid yourself. You've not gotten married. You haven't had kids. You haven't gone on vacation. You haven't bought a house. You haven't gotten a good night's sleep in 10 years. You are now at this amazing inflection point in the progress of your life and of your business, and I am uniquely situated to hold your hand and to get you through that, and to get your board through that, and to get your co-founders through that, and your employee base. And this is your life moment. For a lot of you, this is buying a house, it's buying a car, it's having a family, it's getting married, sometimes it's getting a divorce. But it's a life moment, and I am very privileged and fortunate to be in a position to be able to help everybody with that. And that's what gets me out of bed. And it's funny because a lot of people go to law school to do things that are more wonderful than this. They, go to become family lawyers or real estate lawyers, and they're actually people who can help you with real life problems like buying a house or getting married or maybe getting a divorce or getting you out of jail. I'm not one of those people. But this is my way of helping people, and it is very meaningful. I think a lot of times we listen to panels like this, and halfway through, you're sitting there going, why do I really need to be listening to the people on stage? What do they know that I don't? So now you know what I know, why I hope you will spend a little bit of time listening to me, but most importantly, listening to what these guys have to say. So let's talk about who we have on stage with me and why you should listen to them. And I think all day, both before and after us, what's important with the people that are on stage is what they are currently doing. In this case, with the exception of Anna, what's important is what they've already done. So first we have Joe. Joe has sold a company about a year and a half ago, and we're going to let him tell most of that story. But importantly, he sold his company for a significant sum. Anna is a venture capitalist. She's at DCVC Bio. Before that, she was an investment banker at Centerview, so she comes at M&A from two different perspectives. And then over at the end, we have CK, and CK sold two companies. Actually, I don't know which order it is. I think the first one was to Google, and the second was to a Korean media company. And so what's important to remember, especially in Anna's case as well, is every single M&A story is different. I love working with founders who have sold more than one company because they know something. I hate working with founders who've sold more than one company because they think they now know everything about M&A. So what I want you guys to get from this is start to pattern recognize, something that generally this audience is pretty good at. You'll start to hear similar themes. Every story is different, every deal is different, but we hope that through the stories that you'll hear today, you'll start to hear some things that resonate with you, and as you approach your own process to the point that you might get there, you'll think back on today and say, oh wait, I remember hearing about this, let me think about what they said. Or you'll look up one of us and pick up the phone, and we're always available for free advice. Eventually I'll have to charge you. They're available for free advice. Actually, he'll have to charge you too. But anyway, okay, so Joe, and I'm gonna time you guys. I wanna hear your M&A story, the 1.5 minute version of it. So not the whole version, because we're gonna get into a lot of details about all of your stories. So let me hear the 1.5 version of your M&A story.
Terrific. First, just real quick, I am not an immigrant, but I spent the beginning part of my career as an immigrant. I lived in Hong Kong and Beijing, and when I moved back to the United States at the age of 28, I couldn't get a credit card or get a car loan. So I have some experience with what it's like to get started here. I was the CEO of a company called Issuu, a big digital publishing platform that was started in Copenhagen. I joined to run it here. We flipped it to a US company, and we got acquired by Bending Spoons in 2024 for a nine-figure deal. And Issuu was this large, primarily SMB product-led growth business. We had 65,000 paying customers. And one of the things, once Bending Spoons got involved, it actually moved incredibly quickly. And people often ask me, wow, that was fast. How long did it take you to sell your company? And I always tell them 11 and a half years. So the process that we went through was, initially a lot of it was really getting us known to all potential buyers, partly because you want to have that option. All of us want to create trillion-dollar category creators, but we want to have the option just in case that isn't happening. So made sure that we were connected to all potential folks that could also be good for us around distribution, could also be potential buyers, started to really understand the market, how people buy, both strategics, PEs across the board. And we had multiple false starts, actually. At one point we had a term sheet for a really nice deal. This was in 23 that actually fell apart. So a lot of learnings along the way. And finally, in 24, we got this offer from Bending Spoons, had incredible help from a great lawyer and a good banker, and then a lot of people along the way, which we'll talk more about, I guess, as we go.
I was about to say, I'm going to cut you off. Okay, CK, pick one of the two. 1.5 minutes.
I'll start with the second company because that's more recent memory here. So first of all, I'm CK. I'm originally born and raised in Korea, and been living in California for the past 15 years. So my M&A story for my last company was we never intended to sell. So we were going out there trying to raise money. We had a Series C term sheet in hand. And then we had to go back to the existing investors to get the approvals, obviously, right? And then one of the investors happened to be a strategic investor. And then they were like, hey, can we don't raise money from a third party, just raise more money from us. But we didn't like that idea because they already had a cap table presence. And if we raised more money from them, we didn't like the fact that they were getting too many shares. So back and forth. And that discussion became an acquisition discussion. So yeah, initially we didn't try to sell the company, but it kind of became that way. And part of the reason was because the eventual buyer was already on the cap table. So, we were in a pretty unique situation in that sense. Another thing I want to mention here is, there might be people out there, the founders, hey, I ran my company for 3 years and I'm tired to death. So for our company, the acquisition happened in year 9, and Joe just mentioned 11 years, right? So it generally takes a very long time to build a company. So don't think that you're year 3, year 4, and you're the only person who's really grinding, because generally these things take a lot of time. And I'm the first one to say that, hey, these things take a long time. What if we quit in year 8? We probably wouldn't have had the exit, right? So yeah, taking a long time. So hang in there. Yeah.
That's fair. So there's a lot of people that show up in a deal. I think one of the questions that I get often, I think you guys get often when talking about these processes is, how long does it take? And Joe started to answer that, as did CK. The next one is who's involved, right? So let's see. You have your founders, the rest of your executive team, your employee base, your lawyers. You can't actually do a deal without lawyers. Lucky for me, bad for everyone else. Bankers, maybe. You have the sponsor of the company that's buying you, and the sponsor is really the person who, not necessarily the decision maker, but the person who is bringing you along for the ride. You may have a corp dev person who is someone different. You have that decision maker. Maybe it's the CEO of the buyer, if you're lucky. If not, it's somebody a little bit lower down, but there is that decision maker person. You have their lawyers. Maybe they also have a banker. You probably have in-house accountants, but you probably should also have outside accountants. who am I missing here?
You have everyone doing due diligence on the buyer side.
The buyer, so you have the buyer diligence accountants, and then you have the entire in-house buy-side legal team. And that could be anywhere from 10 people to 500 people. Think about Google, they have basically an entire law firm in-house. And they are all focused on you and your company and nothing else for 2 to 3 months. And so the people involved is massive, and they can all show up at each deal in a different way. So Joe, let me start with you. How did the key people in your deal show up on your deal?
So when we actually signed our term sheet, we had a meeting to sort of get started, and there were 28 lawyers on the call, including Larry over here. They had 14 and we had 14. And I got on that call and I started doing the math about how much all these lawyers were making during this call. It's a big chunk of the deal. Anyway, so you start to understand all the different nuances of, there's going to be an HR lawyer that's going to understand all the pieces of how you're set up from an HR piece. There's some other people that we didn't talk about. Your family. My family was incredibly important. This process, once you get into it, is the most grueling, exhausting professional experience I ever had. I got to a point, when we had a relatively quick due diligence process, it was about 6 or 7 weeks. But I got to a point where, towards the end, I was literally asking our lawyers, at 4 o'clock in the morning, can I take a 2-hour nap now? Because we're going through minute detail, especially with disclosure documents and all that sort of stuff. So family becomes really important for them to understand you're going to be going through an incredible amount of stress. Exercise, whoever you exercise with or your exercise partner or exercising on your own, make sure it gets incorporated into your daily life to the extent that you can. Eating well. And then internally, it's important to identify who are the people, very small universe of people that are going to be involved in the beginning of it. So your CFO, likely your analytics person. In most cases, most of your leadership team, if not all, your HR person becomes really important. And I sat down with my team as we started to get inbound interest on the PE side and some strategics, which is why we hired a bank in the first place. And I sat down with just the key leadership team and said, we are likely going to get into a process over the next 6 months. We need you totally focused on executing, growing and building and running the company. My CFO and I are going to try and handle almost all of these different pieces. There's also a huge piece around aligning the board and investors. So often there'll be, each investor often has their own bias. They often have their own perspective. It depends on how they're feeling about the company, but often it's influenced by how other companies in their portfolio or in their firm's portfolio are doing, how they're competing with their other partners. So there's a whole set of discussions that need to happen to get people aligned.
Did you have a banker?
We did have a banker. So we used, for us, on the banker side, we were in the process in 2024. It was dead. Nothing was going on. So I had the biggest banks in the world trying to do our deal. We were a low 9-figure deal. Nice, but we were not a multi-billion-dollar deal. JP Morgan was courting us, and I'm like, guys, you have nothing else to do. So you're bored. I'm really flattered. But the second the market picks up, we're not going to get your attention. So you want to make sure that if you work with a banker, that you are working with someone that's in your lane, that has experience in your category and is going to give you the attention. So just the biggest name isn't always the best. We had a good mid-tier banker.
CK, did you guys use with a banker?
No, we didn't have a banker. So again, the eventual buyer was already our investor, and we had a strategic relationship, so we knew all the right people. So it was a little interesting because the same set of people, one day you're talking about the business relationships and potential synergy, and then the same set of people, the next day, they're talking about the acquisition. So it was quite interesting dynamic for us. But so we were fairly small team. We were represented by Fenwick, and then the Fenwick team was really, really helpful. So one interesting thing about us, our deal was we didn't have a CFO back then. So we hired a part-time CFO for this acquisition deal. And what I tried to do was to have that person be a bad person, like specifically all the bad things you have to say.
A no person.
Oh, no person.
A no
yes.
man, yeah.
No person, yeah. Bad cop, good cop. And so I would show up because, like, it's a push and pull, right? Like, there are some contentious, like, some tough negotiations you have to do. And then, like, I would try to, strategically use him. It's like all the bad things we're supposed to say, it comes through you. And then I would, try at the show at the last minute and then, hey, just be easy. Like, don't be like that. And then I, try to be a good person. So, that was one thing. I guess the larger theme there was not everything has to come from you as a CEO. Of course, a lot of people try to listen from you, but even outside of this, when I was running the company, we tried to do like a brown bag series where I would try to invite some of my other founders and then have them do the brown bag and then kind of share their lessons. And then sometimes exactly the same thing that I try to tell my people, they wouldn't really listen, but then exactly the same thing comes from my friend and then they're taking notes and everything. So yeah, that was quite interesting. And I guess the theme there is not everything has to come from you as a CEO. You might want to have a team of people, and depending on what you say, different things can come from different people. Yeah.
So coming back to it not needing to come from you, I think, when people think about bankers in a deal, and again, you always have to have a lawyer, but you don't always have to have a banker. And I used to be of another mind on this, which is that all bankers were horrible and they provided no value whatsoever. I've come to realize they can provide values in ways that you don't appreciate. So obviously, yes, if you don't know who all the buyers are and you need them to introduce you or introduce you to new buyers, for example, financial buyers, private equity that you may not already have connections to, they serve that purpose. There are organizational goals that happen in the course of a transaction that are absolutely necessary, and they serve that purpose. But they can also serve a lot of this, coaching you through different types of negotiations if it's not in your nature, or you don't have a no person, or you don't know what things should come from me, what things should come from my CFO, what things should come from neither of us. Maybe it's better coming from the lawyer or from the banker or someone else, because on day 2, this is going to be my employer, and I don't want to have that uncomfortable conversation with them. And so let's kick that to a banker. Now, they are very expensive. So Anna, putting your not banker hat on, but your VC hat on, when you have a portfolio company that is selling and they come and say, do we hire a banker, do we not hire a banker? What's your answer?
I think it depends.
Very good lawyer answer. Good job.
Well, it is true, right? It really depends on situation. One of the companies that we sold from our fund 2 was in AgTech space, and it was also strategic. So we didn't need a banker. And the deal was on a smaller scale for sort of VC. It's not $1 billion, but it was still great IRR, very fast. I think we invested and sold in like a year and a half. But in that case, we didn't go to a banker. Now, we have a lot of companies that are therapeutic companies, and even when they have partnership transactions, sometimes we actually encourage them to talk to bankers, because sometimes you just need to see the breadth of what's out there, understand who are the key players, and if you have an independent person who is professional in the field, that's a great relationship to start nurturing, especially if you think that M&A is a path to exit, because these days bankers all try to work with startups. When I was in banking, that was not the case. We only focus on really big clients, billion plus, who usually acquired companies that were also relatively large. These days, pretty much every bank would have a team dedicated on venture, right? And very often they would develop relationship with you where they take no fee. For them, it's very important to be on a good side with you. When you're ready to pull the trigger, you're going to call them, right? And they invest in those relationships, and that's why for like some advice, you basically get it for free. But of course, if there's a real transaction, then that's when they get paid.
Just a couple things on bankers also. I totally agree with that. And I spent a lot of time talking to bankers. Bankers are talking to everybody. So a good banker is talking to every single company in your particular category, and they tell you a lot of information. I got more sort of intelligence about what was happening in the ecosystem and the environment that we were in from talking to bankers, because they had just talked to 30, 40, 50 other companies in and around my world. So super valuable. And then you get to know them. One of the things about this entire process, whether it's your bankers, your lawyers, is you want to get to know people that you're going to be working with at some point down the road, so that they know who you are and they know your business, and you know whether these are the kinds of folks you want to work with. The other thing around bankers and in the process is the people that you're working with, even your advisors, bankers, lawyers, will give you conflicting advice sometimes. And so, you know, in our case, we had a good term sheet, and my bankers were encouraging us, let's just get it signed and we'll get to the definitive agreement after we get it signed. And one of the great things with the legal team that we had, again, Larry sitting over there, Larry wouldn't let us sign the term sheet over and over and over again. He's like, nope, we need to make sure we get every element into the term sheet so that by the time you do get to the definitive agreement, it goes really smoothly. And there were times I was like, I just want to sign the term sheet because we're going to lose this thing. And my bankers were like, sign the term sheet because we're going to lose this. And Larry's like, no, we have to define what net working capital is, because if we don't define it right now, it's going to be a huge issue when we get to the definitive agreement. And there were so many of those elements along the way that enabled us to have a really smooth process.
Let me give you just a quick anecdote for what it's worth. And this, I say it this way because I think it's somewhat memorable and a little tongue-in-cheek, but it doesn't make it less true. Your term sheet is your #1 highest point of leverage as a seller. That's your high watermark. Everything after that goes downhill. Why does it go downhill? There's lots of reasons, one of which is exclusivity. You can't talk to anyone else, so you can't create any kind of competitive leverage at that point. But think about it this way. At no point in the history of all M&A, all the millions of deals that have ever been done, has a company, a buyer, signed a term sheet with you or with anybody, and then come to you 10 or 15 days later and said, oh my God, we've started doing the diligence. Joe, this company is so much better than you said it was. We're going to give you $50 million more and better terms.
Never.
Starts here, goes down, which means you want here to be as high as possible. Larry wouldn't let him sign the term sheet because it wasn't high enough yet. You needed to have as many things in there as possible. It's not binding, unfortunately, but it's a high watermark. It's, you know, a moral obligation. And no buyer wants to start cutting that down in an obvious way. And even if they do, they go from here to here. Well, that's a lot better than if you started here and they go from here to here.
And
right?
it gives you the starting point. During the process, there are going to be a few points where the legal teams can't agree. And it's going to need a CEO to CEO to talk through. And the term sheet sort of gives that, the foundation for how to make that argument and discuss through it.
Okay, so let's talk about another body of people that show up on a deal, the board. Anna, where do you see things go wrong in the way in which founders either involve their board in their process or don't involve their board in the process?
I think you have to be aligned, first of all, right? The founder and the board, you want to be aligned on the deal. So in that particular transaction that I mentioned, the founders, well, actually, the CEO was not even a founder in that company, but the company is based in Denmark. And for them, an exit of 50 million is a great exit, right? For us, it's a no-go. So, taking into account like very specifics of, we know the culture and we know that they can actually agree to a lowball deal. When we invested in the company, even before an M&A, we put liquidation preferences that were higher than traditional, what you usually see in a venture deal. And the reason we did that, because we expect that the company, the management, will take any offer that comes their way. And we, in that particular case, we thought it's going to be an M&A because we had two strategics on the cap table, and they were competitors, and both of them said at some point that they want to buy this. So that was a very important point for us to protect ourselves, but also give better opportunity to the management to cash out actually more. But because they were inexperienced doing it for the first time, like getting any kind of cash was gold for them. So that was one example, right, where you need to be very thoughtful. But there can be many other types of disagreements that you can have with the board on even selecting the right partner, because for us at that point, both of these strategics came forward and gave an offer. And in our case, it was relatively easy to decide, but I can see how it could have been a much more difficult conversation to have, okay, which offer do we go with? There's the financial aspect to consider, but there's also a very strategic culture fit. In our case, it just happened that the better financial offer came with a better culture fit, and generally we believe this is where the technology will thrive rather than just be absorbed and dissolved, which can also happen in a case of M&A transaction. So there are a lot of nuances that you have to be thinking, and I think it's very important to have these kind of conversations with the board where you try to align the interest.
Yeah, and I think it's a constant negotiation and discussion. So one of the things people often say, selling a company is a marathon, not a sprint. It's not true. Selling a company is a decathlon, not a marathon. You are constantly negotiating and navigating through multiple elements at the same time. So, like, yeah, you want to get aligned with your board well before this even happens. Again, we're all trying to do big companies. And we need to, as the CEO and the founder, need to be really clear. We've got really start to distinguish between real momentum and people buying your product because they're curious. Real momentum in the ecosystem is going to be able to, you're going to be able to keep growing rapidly. And if you're running into problems, you need to start thinking about what's the exit going to be before it's too late. And so you want to start aligning your board at that point. But even in the process, we've got 4 days before signing, and there was a clause in the definitive agreement, very standard, that one of my board members had read, well, was supposed to have read at least once or twice. And we got to the end, and he was like, "Oh, we can't sign that." I'm like, well, what do you mean you can't sign that? We're not signing that. You're going to let the deal go because you don't want to sign a completely standard. It didn't work for the way that their fund was structured. So we had to renegotiate something. But like, even 4 days before we signed, we were still in the midst of discussions and negotiations.
And I can give another example too. Still the same transaction, because we had two strategics, they ended up suing each other, which is never fun. You're already undergoing sort of a stressful process of M&A, and now one of the companies suing another and suing the board and suing the shareholders, including the management. And so the management at some point freaked out and said, hey, we're going to take this low ball offer just because we don't want to be sued. And we had to, have a conversation that there's an insurance indemnification and, like in case something happens, you covered. But it's not always easy because it doesn't cover everything. There's still certain ways where you can be financially liable for something. And it was very scary for one of the founders. And it was a real conversation between us and that person, us as the board, and specifically our fund, to kind of educate that person on what it means. And generally, this is totally normal. And we knew both of the strategics, and we 100% expected the lawsuit. We knew from the get-go when the offer came in, there's going to be a lawsuit. And having these conversations, I think, made it feel, the founders felt kind of more comfortable saying, okay, you guys understand what you're doing and we're going to trust you. But it was not an easy conversation. It was not one conversation. So things like that can happen as well.
But you probably had a good relationship with the founders. Right?
We had, yes. We were one of the major shareholders. We own something like 30% of the company. But it's still a difficult conversation to have because, we could pull the trigger and say, hey, we're just going to vote over and push you to do this, but it's not the situation you want to be in, right? You want to be aligned. You don't want to be a bad guy here because that may result in a whole bunch of other things that you just don't know.
So if you guys are a note taker, or you have a note taker that you're using, literally right now, write this down if you haven't done it, and about 70% of you haven't done it. Go and buy your D&O insurance. Your lawyer has told you to do this, your board has told you to do this, your co-founder has told you to do this, someone has told you to do this. Go do this just for this reason. Public service announcement over. CK, how is your relationship with your board going into the process?
It was pretty smooth. I don't think we had any major drama. So, now that I think about it, I almost wish that we had more drama to be able to tell a more interesting story. But
just wait for the third one.
Yeah, it was pretty smooth. The only time when I realized that, hey, everyone's interest is slightly different. For the most part, we were aligned. Selling the company would have been good exit for everyone, involved. So for that, on high level, we were pretty well aligned. We eventually had another bidder. So the acquisition discussion happened, and then we had to go back to the term sheet, investor, and then we told them, hey, we can't raise money because now there's an acquisition talk, and then they also brought in another potential buyer. So it became almost like a 3-horse race. And then at that point, me as a founder, I was almost leaning towards the other acquirer because, the life after looked better. They had a better strategic alignment. So I was almost 70% leaning towards this company. But then the board wanted, they didn't really care too much about the life after because, for them, they would exit out and then they don't really care about, what you, would be after the sale as a founder. So yeah, that was a little bit of a misalignment there, but for the most part, we were pretty well aligned. I guess part of the reason, something that helped me was I try to catch up with the board members as casually as possible, as often as possible. So what helped was some people were actually living pretty close by. So I was living in Palo Alto, and one of my board members lived in Los Altos. So we would just grab coffee all the time. We would just not talk about the
during
business.
the process or just generally?
Just in general. Okay. Just in general. So yeah, for the most part, they were all caught up with all the information, and even when the acquisition thing happened, the first way of breaking the news was not a formal board meeting or email or something like that, but it's just individual meetings, coffee chats. So I think those really helped.
There is a point when you decide to sell your company or the board decides to sell, or there's it's hard to pinpoint exactly when is the moment where we say, yes, we are definitely selling the company. For some companies, it is in a board meeting and they make a formal decision. It rarely happens that way. But right around that time, generally, there becomes an obligation by you to keep the board informed and to be well informed basically from that moment forward. And so maybe your once a month, once a quarter board meetings become once a week. Sometimes it's multiple times a day at different points, but it is on a much faster cadence. And so there is an obligation to do that. And not everyone has that kind of board alignment, either going into it or not. Larry and I actually used to work together, and we worked on a deal a long time ago where you could say that the board dynamic was frosty at best. And that created a lot of friction, and it does in a lot of deals. You guys did your companies for 9 years, 11 years respectively. When you're with someone for that long, no matter what the relationship, there's friction, there's warts that come up, and you want to try to the extent that you can create that alignment before you go into this process. Your board can actually be incredibly helpful. They've been through this a lot. You've been through this either 0 times or maybe 1 or 2. They've been through it a lot. Your other advisors have been through it a lot. And this is the moment where they can actually add value, so really lean on them. And you can't do that if you're all fighting. So let me ask you, we talked about it a little bit earlier, Joe, but CK, you mentioned having a no person. These processes are psychologically difficult. You have a full-time job. You are trying to grow your company. In your case, you are trying to raise money. this creates a whole second full-time job on top of that. You had your no person, but what else, if anything, was challenging about that time for you personally, and how did you get through it?
Yeah, it's just making sure every day, day-to-day business is running well, right? So, and then there's like a different, I guess, like circles of people who get the access to the information. Like initially, they'd be
It's under the tent team is generally what it's referred to.
Right, but then eventually, as the process goes goes longer, more and more people would know about it. Like, at least like they were talking to someone, right? So you can't like completely like keep it close to like 3 people forever. So yeah, progressively you get more and more people kind of like knowing what's going on, and then still making sure, hey, like it's business as usual. Everything has to go up, and even the buyers, right? I mean, like they will constantly keep an eye on your numbers. So just the fact that like because you're busy doing this deal, you can't say, oh, like our May number is down because I was so busy, doing this deal. You can't say that, right? So the numbers needs to continue going up, which means that you have to have other sets of people who are like not paying any attention to this deal or get involved in this, but like fully focused on building the business. But the challenging part is everything comes down to the CEO. So like either operation or the deal. Of course, you have a lot of other people involved, but there are so many areas that you're being pulled into. So your bandwidth is really becomes really thin because you can't just completely focus on this deal only and completely forget about the day-to-day business, but you still have to be somehow involved. So yeah, it was challenging, but you have to do that at the end of the day because you're the CEO, right? And for us, like try to systemize things as much as possible. The data room obviously really helped. I think that was a big lifesaver for us. Just the fact that we've been like creating really good data rooms. Thank you Dropbox. So yeah, just like kept improving the data room so that we didn't have to repeat the same thing over and over again. Was really helpful for us.
Yeah, I think one thing is something like 50% of term sheets or LOIs end up not having a deal, right? So you're on this roller coaster where you've signed a term sheet with a really good buyer that you're generally excited about, and it may fall apart. So on one hand, you're super excited. This is going to be life-transforming money if we get to the end of this. And on the other hand, I was constantly watching and making sure that we were performing. You have to keep performing. And so it's running a company, we all know, is extremely stressful just in its own right. This process just gets escalated even more. The other piece is around it is like, it's not just a 3-month process. Like selling a company, getting to that 3-month process often is multiple years in the making of building relationships with potential buyers, having false starts with some. You've been doing this for, in many cases, years, not just running a company, but somewhere in the back of the mind thinking I'm going to prepare for some kind of liquidity as well. And so all of that is compounding as we're moving forward. I didn't see how many people raised their hands when you were asked how many here want to sell your company. But we could ask a question, how many of you here will likely sell your company if you're successful, right? 99% of VC invested companies do not go public. And so a successful exit is selling, and so getting acquired. And so you're in that emotional state of thinking through that, this combination of like, do I sell? Do we go big? Or is this LOI going to happen? Or are we going to be able to get the money? Like, there's this constant flip-flopping back and forth. It's takes a lot of energy.
So let me ask you guys one last question, and this is a little tricky one. In a way, it's looking at a crystal ball or at a situation that doesn't currently exist for you. Given the headlines, given the panel that we just had, the entire topic of this conference, you sold your company a year and a half ago. Your last sale was 3 years? 2023, so two and a half years ago. If you had to do those exact same sales today in this environment with your own status, the status of your employee base, do you think the deal would have gone the same?
Yeah, we were an unusual case. Like, we were a company that started in Denmark, flipped to U.S. Most of my employees were in Europe. We got acquired by a European company. I had a European potential buyer. We had a buyer, potential buyer. We were talking to in Australia. We had one in the U.S. So we were kind of our employee base and immigration status was not in the critical path for us.
But you were US-based being acquired by a foreign entity?
Yeah.
So maybe not.
Maybe. But, one thing, I don't know, because the guys who acquired us just acquired Vimeo, AOL, and Eventbrite. So looks like they're still able to buy. But I will say that we did flip it. When I joined Issuu, we flipped from a Danish company to a U.S. company, in large part because I wanted to make sure, I think if you're a U.S. registered company, you're generally in a better position for raising money, getting acquired. There's fewer questions that get asked. We got asked, one of the things that on the due diligence side that folks dug into was the status of every single one of our employees. So we had not everything, we weren't totally perfect on how our contractors were structured in their deals and things like that.
How they were classified?
Yeah.
My answer would be absolutely no. Like if the same thing, by the way, I misspoke. We sold the company in 2021 at the height of the market, right? And then the reason is because, we might have been sold to someone else, but then if we're talking about the same buyer specifically, then the deal probably wouldn't have happened if it didn't happen back then, because that company, the acquiring company, went through a lot of like shitstorm, like unrelated to our acquisition, but because of management change, a lot of different reasons, and they were trying to buy. They bought another company, which turned out to be a bad acquisition, so on and so forth. So. Absolutely, the deal wouldn't have happened if the deal didn't happen in 2021.
Just real quick on that also, we often get in our minds, my particular company, we're a SaaS company, we're an AI company, companies in our category are selling for X multiple. The environment is shifting all the time. So we'll lock in and say, well, sometime in the last 6 months, a company like ours, it depends on profitability, it depends on your growth, it depends on fluctuation in the market. Things change really rapidly. So you need to be ready to be flexible. If we had sold, if my company, if Issuu had been at our current revenue rate, our current profitability in 2021, it would have been an even better story, right? So a lot of it depends on the timing.
By comparison, and folks like me get asked, what is the state of the market all the time? And the answer is right now it's really hard to predict. But Joe said earlier that about 50% of term sheets actually go to deal. Back in 2021, I would say if you signed a term sheet, 98% chance that your deal closes. Today, let me back up another year. We're in 2025. I'd say middle of 23, all of 24. You're at that 50% range, 50% chance if you sign your term sheet that your deal will close. Today, I'd say we're probably closer to 60 or 70, but we are nowhere near the 95, 98% certainty that we once were, and it's probably going to be a very long time until that's the case. So that's not a state of the market, but it is just kind of a reality check that even just getting to term sheet is not closing a deal. I think, so I was expecting this thing to be like flashing red at us and like yelling at us and everything else to tell us to go off, but we are I think over the time that we have been allotted. So unless somebody back there tells me otherwise, I think we're good. Thank you guys so much.